Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Alphabet, the parent company of Google and YouTube, has an absolutely astounding amount of cash on its balance sheet. If you take just its cash and equivalents, it has enough money to pay off all of its liabilities just from the cash and still have another $250 billion in assets left. Like I said, that is astounding. But the question is, maybe that's not even a good thing. I'm Jason Hall. This is The Smattering. And I've got my buddy Jeff Santoro back on our YouTube videos for the first time in a long time. And we're going to talk about Alphabet and its cash, whether we think it's good and whether this stock is a buy or not right now. Hey, Jeff.
Hey, so this is an interesting one. When I found this out, I was kind of astonished that they could cover all their liabilities just with their short-term cash. That's pretty crazy. But a friend of ours did say, as a shareholder, he didn't like that. So let's dig into why.
Yeah, so I'm going to share this first. Here, just a quick screenshot, this visual of that number. Again, about $114 billion in cash and short-term equivalents. Those are basically treasuries that can turn to cash really quickly. And all of its liabilities, so all the money it owes to vendors, leases, property that it has, like all of it, like everything that it owes to everybody on the planet. You pay off all of that and have money left over, and then subtract that 113 from cash, and you've still got over $250 billion of assets left over. So Jeff, it shows right here, this is the cash flow of the business. So that cash is continuing to build, and that balance sheet strength is continuing to build. Let's start off and talk about, in what realm of the imagination is it possibly bad for a company to have so much cash and so little debt and so little other liabilities on its balance sheet?
Well, you have to remember that one of a management team's basic functions is to decide how to allocate capital. So once you pay for all the things you have to pay for, you get to make decisions about what to spend that money on. So the fact that they have this much short-term cash and cash equivalents on the balance sheet says to me that they've made a conscious decision to not use that money for something else for the business, which is interesting to me because even though they're the leader in search and in video with YouTube, there are parts of the business that are pretty cash intensive. Like they have a huge cloud infrastructure business that is still competing with AWS, which is the leader, and also Azure from Microsoft. So you would think they could maybe invest a little bit more money in to try to catch up and get some market share. They also have their other bets part of the business. This is where they do things like Waymo, and they sort of put a little money into these like moonshot ideas in the hopes that they turn into a big part of the business down the road. There's no reason you couldn't make the argument that they could be putting a little bit more money into some of those in case they pan out. So there's a lot of different things they could do. It is kind of curious that they keep this much cash just on the short-term part of their balance sheet.
Yeah, and I think another part of it to remember too is that typically when you look at a company, and this is important, generally businesses don't have enough cash that they could pay off all of their liabilities. That is a substantial amount of cash. Generally, companies will use some level of debt or some sort of leverage to try to boost returns, to get better overall returns by using some leverage of some sort. And it's interesting to me that this has just been such a cash cow business that management hasn't had to pursue or chosen to pursue any way of maybe applying a little bit of leverage to be able to boost its overall returns without increasing the risk substantially. Because that's the thing, you can use leverage responsibly. The other thing, Jeff, that it tells me, and this is kind of a little bit of a concern, and you mentioned this to me before we taped, and in retrospect, I kind of poo-pooed it, but in retrospect, it's like, you know what? What? You have all this cash just laying around. It hasn't been smart to have it laying around for the past half decade or so because there's so little yield. It's unproductive on your balance sheet. It's just sitting there as optionality, and it's obviously more than the company needs. Why don't you start giving more of it back to shareholders? And you mentioned a dividend, maybe not a dividend, but what about accelerating share repurchases? There are ways that the company could put that cash to work in ways that would lead to better per share returns for shareholders. What do you think?
I agree. Accelerating the buybacks or maybe even thinking about a dividend is not the worst thing in the world. There are other big tech companies that do pay a dividend, even though it's modest. The other thing I'll say just in closing, Jason, is that I did also wonder, should they have taken on more debt when interest rates were really low? They obviously have the room on their balance sheet for that. And back when you could get a ton of debt for basically nothing, it might not have been a bad idea to load up on some. They still would have been in very good shape. And now, if for whatever reason they needed to go get debt, which it doesn't seem like they will, but if interest rates stay high or higher for a while, they could be in a position of needing to get debt at a higher rate, having missed the opportunity to get it when it was near zero.
Yeah, I think that's a really good point, because if you look at if you look at Apple, and if you look at Microsoft, those two companies have 111 billion and 48 billion in debt respectively, because they did exactly that. They were levering assets that generate cash flows outside of the US to take on those debts to do it, but at extremely attractive rates. And it's given them more cash to be able to use for things like share buybacks, and for both of those companies, dividends that they've been able to increase. Last question before we wrap up the recording here. Do you think, looking at Alphabet right now, looking at how maybe management hasn't done as great of a job with allocating capital as they possibly could have over the past 5 to 10 years, do you think Alphabet's a buy?
I think it is. It's really fairly valued. The price to earnings ratio is not far above the market average. And you have to remember this. We are talking about a company that has been very conservative with their cash and their balance sheet in a time when we're seeing a lot of other companies really suffer the consequences of not being prudent and not being careful. So I think it's a buy. The valuation's attractive. There are worse things in the world to complain about than a company being a little bit too careful with its cash.
Yeah, trading for 23 times free cash flow, about 15 times operating cash flow. I think you're right. And I think it's interesting, because this is hindsight bias, us talking about all this cash, and maybe they could have done a better job with levering it in the past. Now is the time that having that cash is certainly going to pay off. I think you're right. I think at these valuations, it's absolutely a buy, and it's a super high quality company. And I think investors would do really well to own it.